That's the closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blickery joining us here to break it all down. Jared.
Thank you, Josh. Nice comeback Friday. We're seeing a lot of green on our screen here, at least in terms of the major averages. We'll start with the NASDAQ, up about 100 points or 0.4%. Here's the day's price action. We had a little green, a little red in the early goings, but we are ending on a high note at the market highs. Here's the Dow, up 300 points, just off of those highs, but still worth about 6.5%. And then the S&P 500 up about 0.6%, pretty close to its highs as well. And just to tell you what we did for the week, down about 0.3%. And for the Russell 2000, that's going to be down for the week as well. Worst week since August 1st, but still in the green for today by about 0.8%. And let's just check in on the sector action, shall we? And we saw early on, utilities was leading along with consumer discretionary. Those are the top two there. Also, materials, healthcare, real estate, all up more than 1% on the top row. And what really stands out, everything in the green here. And the least good here is by consumer staples. That's up about 0.2%, followed closely by tech. Those were the only underperformers. And then if we take a look inside the NASDAQ 100, it's a story of Tesla and Intel. Those were both up more than 4%. And I want to show you Apple. Apple's down about 0.5% today. But over this week, we did tack on gains of 4%. And if we take a look at the year to date, guess what? We just turned positive. So Tesla turned positive on the year last week, and this week it is Apple. So the mega caps coming back, at least someone, not all of them today. And if we take a look inside the Dow, see how that wrapped up, the standout was Boeing. That's going to be the year to date. That's up 25%. But let's just check out the week, up about 2.5%. Most of those gains coming today. And I will leave us on our leaders and sentiment. We can see that biotech, XBI in the upper left, that actually took the number one slot, up over 2%. Then innovation, the ARK Innovation Fund, up 1.8%. Transportation did well, so did home builders, value, retail. So a pretty good mix there. The things that didn't work today really were China, solar, and a little bit of emerging markets, and then crypto. We'll talk about crypto later in about 30 minutes, Josh.
All right, Jared, thank you. Well, given all the market forces at play, tech exposure may be the safer bet, but there may be other sleepers in healthcare, staples, and more. Doug Butler, Rockland Trust SVP and Director of Research. Doug, welcome to the show. Look in here, green all over the place here, Doug, in today's trade. What do you make of this market? Where do you think we head from here, Doug? I keep being cautioned to expect a near-term pullback.
Yeah, I think today's numbers that came out and yesterday's probably eased some of the stagflation fears that the market was having. And you saw the rally across the board, like that equal weight outperformed large cap overall, and that, in a sharp up day, tech was sort of a laggard today, which is unique for certainly this market rally. I think that's what we see more of going forward. We see more breadth coming to the market. And that, it isn't all going to be Mag 7. It isn't all going to be your top 10 names. It's going to be some of your names throughout the space. Again, I think I highlighted for you one of our top picks in staples, which was Pepsi, which we think has a really strong turnaround story, has been beaten down pretty bad. We think they can make a recovery. I know we keep hearing about the GLP-1 drugs, and especially if they're coming out in pill form, what that does to snackers. But again, we think that the taste for salty snacks will not be something that dissipates, completely from our universe and from the American diet. We're not going to stop eating greasy food.
So Doug, you're finding staples that you like. You mentioned tech as well, and certainly, the great AI spending boom, that was a focus this week, Doug. More headlines there. The numbers are just historic. Does that mega AI trade and trend, does it look intact to you, Doug?
I think there are aspects of it that look intact for us. So we really like, we own Oracle. We had a great experience with that over the last 6 months. We are long Microsoft, we are long Google, we are long sort of the hyperscalers and the people who are implementing. We think that it's likely that the semis and the Nvidia story is probably coming close to an end. The amount of investment in capital equipment, we're seeing it right around the peaks that we saw back in the late 90s, early 2000s bubble. Again, and I don't want to say, bubble is probably the worst thing to say, as well as it's not different. It's different this time. But again, you're seeing spending. So we think the people who've enabled AI thus far have received bulk of the rewards. We think now AI becomes a monetization story, and all of this capital investment, we have to see that it generates the returns, that we're going to get that ROI. I think that's why you've seen some weakness the last few days in Oracle, just because people are not sure of that. And I think our other big concern around the space is the amount of cross investment we're seeing. That always feels a little uncomfortable when you see, somebody is investing in somebody who is one of their biggest clients, who then trumpets them as one of their as one of their great stories. So again, and we see it with Nvidia and Microsoft, but also OpenAI in particular.
Another story we're talking about today, Doug, and I want your take on this, was the president on social media calling for these new tariffs. You saw this, pharmaceuticals, big trucks, furniture. I'm just curious, Doug, how as an investor, when you see those posts, when you see those headlines, how you try and navigate that and think through that, Doug? Does it impact in any way how and where you want to put money to work?
I don't think it impacts how we put money to work, but it would certainly impact us on a day-to-day basis. So again, for the vast bulk of our clients, we're not investing for the next 2 or 3 months. We're investing for the next 2 to 3 years. And so when we invest, we're really committing to a long-term investment there. But the president, especially with the tariffs, has made some of the math work much harder. So you're always a little concerned when he, in the pharma space, it's looking up like, well, who's going to be impacted when it becomes a countrywide question in terms of Brazil. But to be fair, you also have to temper it with what is said and what is done. So we're still at, there's been incredible amounts of talk, and we have gotten dramatic increases in tariffs, but not to the level that is the sort of published rate. So we still think that most of the time, look, the president loves deals. And so announcing these things and then figuring out a way to make it so that we roll it back or we get more investment in the country, I think that's what a lot of this is signaling. There may be short-term impacts in terms of quarterly flow, but really nothing that we think impacts it long-term. Because again, if we went, I think if we implemented all of the tariffs, that would be highly recessionary and probably not what the president or his economic team is looking to have happen.
Finally, Doug, just turning to next week, possible government shutdown. Does that matter to you as an investor, Doug?
I think it matters, but it doesn't, it matters in terms of easing clients' anxieties and understanding where their fears are. Do I think that we've seen this happen before? I don't think. I think we've generally seen it the other way around, where it is a Democratic president and a Republican House versus the other way around. And again, I don't think there's a winner if we shut down the government. I think there's always a case to be made for figuring out a deal. And in general, I think by the end of next week, we would expect there to be some sort of deal in place. It may shut down for a couple of days. We don't think it's a months-long shutdown.
Doug, great to see you. Enjoy the weekend.
Great. Thanks a lot, Josh. You too.
Better home and finance stocks soaring this week as investor Eric Jackson said he's buying into the name. Ali Canal spoke with Better CEO Vishal Garg earlier on opening bid and got his take on the company's recent surge thanks to retail traders.
I don't think it's a meme stock. I think we have over 100% revenue growth. We've indicated that we're on a path to profitability by third quarter 2026, so just within the next 12 months. And we have the world's largest asset class that we are revolutionizing with AI, U.S. residential real estate, $15 trillion market, and filled with inefficiencies that are basically like, 60 days to close a mortgage, $10,000 to get a loan, 28 people involved. And we're able to make that nearly instant with AI. And so I think we do believe that we can be the Shopify of mortgage through our platform, Tin Man. And we think the growth prospects of the company are extraordinary in the next couple of years.
And you now have this surge in retail attention in trading volume. How do you plan to maybe leverage this moment, leverage this share price? Are there any conversations about reinvesting back into the business or maybe strategic acquisitions or something else?
I think the biggest thing that we've been doing is I think it re-energizes the company. The company was the fastest growing fintech in America from 2016 to 2021. We built a business that went from 500 million a year of volume to 58 billion a year of volume, over 100x in that 5-year period. But it was relying at that time on refinances through Better.com. We've now, leveraging the advances in AI, reconfigured the platform so that we don't just serve Better.com, but we serve hundreds of mortgage brokers around the country who are building their business on top of us. And we're increasingly becoming the platform of choice for fintechs and other big mortgage companies to build their customer relationships on top of our AI underwriting and processing platform, which also enables them to take advantage of the investor network that we've built, which at its core is a matching engine between consumer credit, consumer properties, and 45 institutional investors that comprise over $1 trillion of annual demand in the mortgage market.
Now, Eric Jackson's targets are pretty eye-popping. He said the company can deliver $12 billion in revenue and a $12,000 share price by 2028. Do you see that as realistic? And what would need to happen both internally and macroeconomically in order to even approach that level of growth? I
think the thing that would need to happen is you'd need to have interest rates likely come back down to levels that we saw not necessarily during the pandemic, but even levels that we saw in the period from 2015 to 2019. I think that would dramatically increase affordability and reduce friction. So many Americans today are stuck in the homes that they either bought during the pandemic or the ones they've had before. And there's a huge migration pattern taking place in this country from the Northeast, from California to the South, the Southwest. And we think millions and millions of home transactions are going to take place. And for us to achieve, that level of revenue would require us to achieve something in the order of about 10% market share in a reinvigorated housing market, which, if you believe that we have the lowest price, which we validate through the better rate guarantee, the fastest closing times, which we share on our website, are about 14 days faster than the industry average, and the fastest approval process, where we'll give you a commitment letter the same day you go into contract on a house. We think that we can get to 10% market share in a housing market that's more stable and normalized with interest rates.
So you just mentioned interest rates, and we do have a Fed that is easing. However, we've heard from some experts that doesn't automatically guarantee mortgage rates will continue to tick lower. So how sensitive is your business to the interest rate moves? And is a Fed cut through the end of the year, multiple 25 basis points, is that really enough to move the needle for your business?
Oh, totally. I think the number of consumers in the money, if the Fed cuts another 3 times, almost doubles. In the consumers in the money for a refinance. And last time in 2021, our peak market share was about 2.5%. So if you think about the 10 million plus consumers that can now benefit from a refinance or a cash out refinance, we're talking a decent number of loans. We're talking about 250,000 mortgages. 250,000 mortgages is almost $1.5 billion plus of revenue that goes to the company, and is a substantially higher level of revenue than what we're doing today. So we think that just a few rate cuts does make a difference, but more importantly, our home equity business is on a tear. We are the fastest growing home equity lender in the country. We're at $1 billion origination run rate. The largest non-bank home equity lender figure is at $1.5 billion run rate in its direct-to-consumer business. So we're about 2/3 their size, and yet our market cap is 1/7 of their size. So I think there's just a ton of room to grow. Home equity used to be $1 trillion business in the US before the global financial crisis, and the home equity line of credit just went away. And in its place came auto loans, student loan, personal installment loans. And all of those products are inferior to a home equity line of credit in that they're much more expensive, for consumers that are homeowners. And all of those products can be consolidated with a home equity line of credit. Our consumers that are taking out a home equity line of credit from Better today are saving $1,100 a month when they're consolidating their debts. That's money that's going back into people's pockets right when they're, income insecure and inflation insecure. So we think there's just a lot of runway going ahead.
The IPO market has come roaring back in the third quarter. Names from Circle to Klarna and Figma all hitting the public markets in recent months. My next guest says this time is very different than the SPAC-driven mania we saw back in 2021 for a few reasons. Joining me now is Dean Quiambo Armanino, partner and technology industry leader. Dean, it is great to see you on set. So the IPO window, Dean, does look open. Companies are taking the public market plunge. Why is it open, Dean? Walk me through the reasons.
Yeah, well, number one, you got to say that these companies, they're performing really well, right? They've wanted to go IPO for a while. The IPO freeze is now unlocked, and now they want to go. Their backers, their investors, whether it's the PE funds or the VC funds that are behind them, want them to go. Their employees want them to go, and they have the financial results that validate that they should go. And then, on top of all of that, you have an insatiable market of companies and of people and of funds that want to invest in these companies.
Does it feel 2021-ish to you at all, or no?
No, I would not say that. It's
Why? How come?
Yeah, because today these companies are fundamentally strong. I think back in 2021, you think about it, there was a lot of, how would you say, selling the sizzle. And today it's, no, we're not just selling the sizzle, but look at our numbers. Our numbers are strong. We have strong unit economics.
There's some meat there.
Put some steak on the plate. That's right.
Let me ask you, does this window stay open? What does that depend on? What are the variables that depends on?
Yeah, there's going to be some macroeconomic things there. Interest rates is one that we got to look at right now. Tariffs is another. I think after inauguration, everybody was so excited that the market was going to just rip with IPOs. And then we had Liberation Day.
Right, some uncertainty creeping in, yeah.
And then everything calmed down for a while. But now that everything's calmed down, now you see companies saying, hey, the window is open and we got to go. The reason for that as well is they might have missed the last window. So they want to go now, right? While their valuation is there and their numbers are there.
When you look at the companies going public, so Klarna and Circle and CoreWeave and Figma, are there certain common trends and themes you can spot, Dean, that explain, okay, the success or not as successful in terms of debuts?
Yeah, that's right. You're going to look at profitability or path to profitability, those unit economics. You're going to see a growth story. They're all telling a very strong growth story, but more importantly, that they're going to say, hey, when we get these dollars, we can execute our growth story. Because they know if they can't execute on what they say they're going to do, they're going to be punished. They're going to be in that penalty box, and it's going to be hard to get out of there. So they really want to say, hey, are we able to forecast our revenue and our results for multiple quarters? As Armanino, we like to say, it's not just about going public, but it's about being a successful public company quarter after quarter after quarter. When companies can do that, all of a sudden you start to see that their market value starts to rise over time. It's not just going public, but how can we build that enterprise value over time? And what that's going to be is strong people, strong processes, and strong technology. If you can enable that, you've got a chance.
Do you need an AI story to go public right now?
I would say yes.
You would?
Yeah, I think I need, there's got to be something adjacent there. Now there's going to be tech companies that obviously there's going to be a lot of companies that maybe they're not tech related. But if you're in tech, you've got to be AI or AI adjacent or have some story in there. And maybe that's even just how we're implementing AI and automation into our business, and it's increasing efficiency. Maybe we're getting margin gains by implementing AI into what we're doing.
Do you, I mean, if you're an investor and you're looking over that S1, how do I try to distinguish, Dean, between, okay, this company really has an AI story versus maybe it just sounds like marketing fluff. What are you looking for?
Yeah, I think you're really, when you think about that, I think about a great example is Chime, right? When you looked at that, they said that they were able to answer 65% of their customer inquiries without using a person. They were able to automate that. So those are things that you're like, okay, they like to focus in a demographic that's under 100,000. They feel like people who make $100,000 or less are underserved, and they can automate responses and have a lot of touch with their customers, create that stickiness. That's a story that would resonate. Or maybe you can talk about Figma and say, oh wow, in that Figma IPO that we all know about, well, they talked about how they can expand within their client base, how they got really sticky, and that there's so many more services that they can expand into. And then how are they going to do that? Well, hopefully it's going to be a little bit of that AI platform, right? They're building a platform and a technology that their customers can easily do more.
You're living and working out in Silicon Valley. Would you say the AI trend and theme out there hot as ever versus like 6 months ago, or if I had asked you 12 months ago?
White hot.
What, really?
White hot. I just went to a AI Finance Summit the other day, and 1,000 CFOs tried to get into that summit. They can only take 150 people in the room.
That's remarkable.
So AI is everywhere. The buzz in San Francisco and in the Valley is back, I tell you. The energy feels good.
Last question, what's the IPO on your radar? What's the name everybody's waiting for?
Yeah, the one that I think we're all waiting for next is Databricks.
Why that one?
Yeah, because I talk to a lot of CFOs. At Armanino, we work with a lot of CFOs that are bringing their organizations forward, and they're growing and scaling, and a lot of those organizations, those CFOs, they tell me they love their Databricks, right? And so when you see a company that a lot of people have been talking about for a long time, where their customers love the product, it's going to be exciting. It's going to be interesting to see what do their numbers look like, right? We all talk about the rule of 40 in public companies as they go, which is a gross margin and the growth rate. Does it equal 40 or not? It'll be interesting to see what that number looks like for Databricks. For Figma, it was 63. So.
When that S1 hits, we'll have you back. Thank you, Dean. Great to see you.
Thank you.
All right, time now for what to watch on the economic front. Tuesday, we're going to get a check-in on consumer confidence. Economists expecting confidence to continue to decline in September. This comes after the report in August saw rising worries about jobs and income. And on Wednesday, we got a new read on U.S. private employment. The ADP report expected to show private employers adding 50,000 jobs in September. That would be lower than the jobs added in August. And speaking of jobs, we're going to get a fresh snapshot on Friday of the nation's labor market with the all-important jobs report. The U.S. economy expected to add 50,000 jobs for the month of September. The Fed will be keeping a close eye on the latest data as job growth in the U.S. appears to have slowed. And turn to earnings. Carnival, Nike, and Conagra brands all expected to release their quarterly results. Nike gearing up to report its first quarter results amid the company's so-called win now strategy to turn the business around. Investors can also expect more Fed speak. Fed's Christopher Waller, Beth Hammack, Raphael Bostic, Philip Jefferson, and Lori Logan all set to make remarks throughout the week. This comes as the rate debate inside the Fed is seemingly intensifying, sending markets mixed signals. And lastly, a look at what's happening in Washington. The deadline for a partial government shutdown is nearing, set to take effect on October 1st at 12:01 a.m. Eastern Time. And also on October 1st, Trump's new tariffs will be going into effect. The president is set to impose 100% tariffs on imported branded drugs, 25% on heavy-duty trucks, and 50% on cabinets.